record the transactions and we'll see how it is recorded. And so tomorrow when we see the debits and credits, we'll see that it's a very natural extension of how we record these transactions. Okay, so let's take you through this. So first of all, we got a bunch of transactions that happen. Okay, and these are summarized for the whole year. So in some sense, you can think about well, if you feel comfortable, you can think about it as 1 month. So you can just look at one transaction, but it's essentially, say if you take the first item, billings to the clients for services provided, when I say $350,000, that means like there'll be multiple transactions that total up to $350,000, which all relate to billings to clients for during the year. Yes.
I have a question. Going back to
yeah, sure.
When you do a profit and loss analysis, you can use your balance sheet to do that, or is that a separate?
No, the profit and loss comes from the income statement. The income statement tells you profits and losses.
Right.
Straight out.
Okay.
So if you want to know how much profits a company made in a given period of time, you go to the income statement. That tells you right off the bat what the profits are. The balance sheet tells you, as of a point in time, what are the total assets of the business, and against the total assets, what are the total liabilities and what's the total stockholders' equity. Okay. All right, so let's take this. So for example, so we are going to say, all right, so all these things happened during the year. So an accounting system recorded these things in a way, and at the end of the year, it is going to produce an output, which is our financial statements. Okay, so that's really where we are headed. So we are going to, but the first part is the most difficult part, which is what? The recording part. Once the recording is done, you will see that the statements come out very quickly. The recording is the tough part to get at the first, at the initial stage. So now, when we record this, we are recording this in, for now, we are going to be recording this in what we call as the tabular format. No debits, no credits. We are just going to record it as increases and decreases in different accounts. So the company has set up a bunch of accounts which reflect their assets, liabilities, and equity. Okay. So now, there are a bunch of accounts here. And so they are going to say, okay, fine, every transaction is going to be recorded in a particular way. And now comes the most important rule that we said, and in fact I alluded to that a little earlier, where this rule, assets equal liabilities plus ownership. So the recording of every transaction has to make sure that this equation is never violated. So what does that mean? When will you not violate an equation? Right, but remember, you are recording a new transaction. So that means you already, let us assume that it is not already violated. So that means it is fine. It is in balance. Now there is a new transaction coming up. How should you record it so that it is still in balance?
Both sides, yeah.
Changes have to be. So if a transaction changes assets in a particular way, by a particular amount, then the same transaction must change the sum of liabilities and owner's equity in exactly the same way and the same amount. Now the equation will continue to be in balance. So that means that every new transaction represents a change to assets, liabilities, and owner's equity. So we can rewrite this relationship as follows. We can rewrite this relationship as so we can rewrite this relationship so we say assets equals liabilities plus owner's equity. If you represent, I mean, those of you who are mathematically inclined, you know that you can represent change as delta. So we say change in the assets must be equal to the change in liabilities plus the change in owner's equity. And this is where new transactions come in. A new transaction can change any one of these three, But then the rule says it must also change in a way that this equation is maintained. Okay? So let me take you through some simple examples, and then I'll take you through this more detailed example. Supposing it's all in balance, everything is in balance at the beginning of the year. Now the company goes and buys a truck. Buys a truck by paying cash. What has changed here? As have, okay, so
the money
so
went
if
out.
you're saying assets have changed,
Yes.
in what way have assets changed?
The amount stays the same, but the way you record it is different. So if you pay in cash,
Yes,
say $40,000,
right?
you lose the $40,000 in cash, but you
Yeah.
still have the asset $40,000.
Because you have inventory.
That's a different matter. There's no depreciation yet.
We're not there yet.
But you all agree now? If you buy a truck and you pay cash for the truck, you have zero change in total assets, but two individual assets have changed. An asset called cash went down by 40,000 because you paid cash, and a new asset called truck has now come into being. You now have a new asset called truck for the same $40,000. So now let me rephrase. Let me ask you the same question differently. Supposing you go buy a truck,
Yeah.
but you don't pay for it. You have not paid for the truck. The
You
truck
have-
you own it. You've taken it out of the dealers. It is your truck, but you're going to pay the dealer 1 month later, 3 months later, whatever.
Still is your asset, but you have a liability.
Now you have a new asset called truck, 40,000, but no cash is not going down because you never paid, but a new liability called whatever, accounts payable or loan payable or something has now arisen. So now you have a new liability. So see that the difference between the two? In the
Yes,
case
yes.
of the first case, there is zero change to assets, although two individual assets moved in opposite directions. So the net effect on the assets was zero, so there was nothing to do with liabilities or equity. In the second case, when you did not pay for it, only one asset changed, and that is the truck. It went up by 40,000. Now that cannot happen, it cannot stop there. Now that on the asset side there is only a 40,000 increase, now you got to make sure that there is a 40,000 increase on this side. You can't just arbitrarily put it in own as equity. You have to say, okay, what really happened here? What really happened here is that I owe the money. So therefore my liabilities went up by $40,000. So in this case, in the case where you owe the money, then your assets are going up by 40 and your liabilities are also going up by 40. So change to assets is a positive 40 and the change to liabilities is also a positive 40. Now let's take that example. You have $350,000 of revenue that you have billed to customers. Question?
I have a question. I'm kind of confused that
Sure.
the point of reference that you're referring to. When I'm looking at assets, is that me, the customer, or you, the dealership?
You're the dealership.
The dealership.
Yeah, the dealership. We are doing all this accounting for the dealership.
Okay.
No, wait. Hang on. Oh, the one that I gave? That now it is the customer. We are doing the accounting for the customer because the customer owns the truck.
Okay.
So the customer has a new asset called truck.
Okay.
But the customer owes the money to the dealership, so that he also has a liability
Okay.
of the which is the money that he owes the dealership. If the customer paid in cash, then he has just one asset called trucks going up by 40 and another asset called cash going down by 40. So the net effect on the assets is zero. The total change to the assets is zero. So nothing happened to the total assets, but two individual assets moved in opposite direction equally. Okay, so now let's take this example here. So now we have $350,000 of billings. Now when you bill a customer, what do you know? Why do you bill a customer? You've done the job, right? You've done the job, that's why you bill the customer.
Right.
So if you've done the job, you know it's revenue, right? So we know that revenues minus expenses is equal to profits. Right? Oh, this is phi, by the way. This is phi is
Phi.
profits. Okay. So revenues minus expenses is profits. And we already know that profits change owner's equity. What do you have when you have profits? Your owner's equity goes up. So therefore, this transaction, when you bill a customer, changes two things. It changes assets by 350 because you now have receivables. You've generated bills. So all that money is receivable to you. And at the same time, you have earned a revenue. So therefore, your owner's equity also goes up by the same amount. So what we do, what I have done in this example is that I broke up the owner's equity into two things. I call it capital stock to represent money directly contributed by the owners. So meaning that you transfer the money from your personal account to the bank account, that is capital stock. That's not retained earnings. Retained earnings has to do with the money that comes to you because your business made money. Your business made a profit. That also belongs to you, but it is not the same thing as you contributing money into the business. So therefore, we have a separate thing called retained. So there are two things here, retained earnings. And the retained earnings, remember I said retained change to retained earnings is profits and dividends. So you will see that in the way I record it, I record all revenues, expenses and dividends all under this column called retained earnings. So that it captures what the business has done as opposed to what you have done to owner's equity by transferring money or contributing money to the business. Okay. So if you are, let us say if you're a medical service provider and then you treat a customer, you bill the customer or the insurance company, that makes it revenue and at the same time receivables. Correct? That's really what we have here. So they bill the client, maybe it's an insurance company or it is the customer. One of the two now owes together, they owe you $350,000, that's receivables, and at the same time it is your revenue, but it goes under retained earnings. Your retained earnings has gone up and therefore your owner's equity, stockholders' equity also has gone up. Yes?
I understand these transactions as T transactions.
As what?
T transactions. It's a T, a letter.
No,
that you
the
have to.
key you have to wait.
Right, but you have to have always two accounts to maintain equilibrium on a balance statement. Kind of. Every transaction has two phases.
Two phases.
Right.
Without
So
a T.
you can have any transaction with
Wait
only
for the T till
okay.
tomorrow.
Okay.
The T will come tomorrow.
Yeah.
When we do debits and credits, because the T comes
Right.
with the debits and the credits. So without debits and credits, I cannot do T accounts.
Right. But the idea of having two phases of the same transaction
Correct. That is
gives you what you have.
correct. This is the same thing except that it is not through a T account. You're absolutely correct.
Okay.
So you will find that as you move along, some of you are more comfortable understanding a transaction through T accounts and others are more comfortable this way.
Okay.
That's fine. So I will present both. So you will pick it up either way. All right. So now we have the $350,000. Okay. Now let's go to the next transaction number 2.
Is it possible so that you have it initially so we know where we put in where?
You need to do that from your computer.
Okay.
Yeah. Pull up the file on your computer and follow it because what is the best way to do that? I gotta keep shifting between. I gotta pull up the file 2 times, and now that takes me into technology that I'm not good at. So yeah. You what? Yeah, absolutely. No, that's fine. Okay, second. The second transaction says that the client dues collected was $260,000. Okay? Hello, folks?
Yes.
When you collect client dues, what happens? So I have a bunch of accounts that I have given you under assets. So now when you collect your client, remember in the previous transactions when you billed the client, one asset called receivables that went up by $350,000, correct? Now what we are going to have is that receivable is going to go down by $260 because the guy has paid. So when you collect the money, the receivables are no longer $350, they are down by $260. But that $260 goes where? Into cash. Again, yeah, because you collected the money. It's your cash now. So your cash went up by 260 and your receivables go down by 260 and the equation is still in balance. Correct? Yes or no? See, this is the point. No, that's fine. This is the point where I need to go as slow as it is needed. That's the reason for the boot camp. If I rush the boot camp, we have not got what we need to get from the boot camp. So I cannot rush the boot camp. So I have to go as slow as it takes. But we will start building up on this very quickly. So if something is not clear, you need to stop and ask me. Okay? All right. So I'm assuming that
every line item has to equal 0.
well, basically think of it this way. Yeah, you're right about the 0, but basically the idea is the equation. That the change to your assets because of that one line must be equal to the change in your liabilities and your owner's equity. But again, the liabilities, assets and owner's equity are categories. Within that category you have accounts. So you may have some account going up, some account going down. Okay? So the idea is what happened to the total category. That needs to be, that equation has to hold all time. Okay, for every transaction. Okay. Now, what was your third transaction? The third transaction says equipment purchased for cash on January 1, 2011. Assume a useful life. That's for depreciation, so we'll deal with it later. But you paid $50,000 cash to buy the equipment. So what did we do? Well, we have a new asset called equipment for $50,000, and we spent $50,000, so cash goes down by 50. Right? I see, with every line I see more people nodding. That's a good sign.
It must
It's
cancel.
always a good sign.
It must cancel.
Good. All right.
If not, you
600,000. So what's the next one?
one?
The owners invested cash in the business, $600,000. Well, so now, since the cash is invested in the business, so cash is going up by 600. And at the same time, your capital stock is going up by 600 because that's a contribution from owners. It is increasing owners' equity, but it is increasing the capital stock component of owners' equity, not the retained earnings component. Because the retained earnings think about the change to owners' equity. So this change to owner's equity as coming from two broad things. Okay, so this comes from contribution or contributed capital. And think of this as earned capital. There are two ways you can generate or you can increase the capital of your business. One way is to simply put money into the business. That increases the capital. The second way is to have the business make money. That is what we call the earned capital. So the earned capital comes from what? Revenues minus expenses. That's your profit. Then from the earned capital, you take away some money for yourself because you're the owner of the business. That is dividends. So when you pay yourself a dividend, that reduces the earned capital. When your business makes a profit, that increases your earned capital. So the earned capital effect is more complicated. The earned capital effect is more complicated because it comes from both profits and dividends. Whereas the contributed capital effect is pretty simple. You just simply put money into the business. Yes?
Does it matter where the contributed capital came from? What if it came from another part of that business? Do you have to take it away from somewhere else?
Now that's an excellent question. So when you say it came from some other part of the business, what do you mean by that? Give me an example.
A loan? You want to see a loan?
I'm thinking.
I'm
looking at more if you have two different sides of it. I don't know how to explain it.
Here's the way you look at it.
It's the owner contributed. Right? You're saying in this case the owner contributed the $600,000. But if
Okay.
he earned that $600,000 from the business, isn't he still taking it from the business? No.
Okay. I thought you were going somewhere else. That's fine. The point is that when you say it comes from some other part of the business, it's important for us to understand what your entity is. Here the entity is the business. If the entity is the business, the owner is separate from that. The owner is a separate entity. So when the owner puts money into the business, that's contributed capital. Why? Because it's coming from a different entity.
So that's his.
When the business earns profits by itself, that is earned capital. The entity itself earns the profits because of the revenues exceeding expenses.
And what you thought the question was, what do you think, what would be a third entity?
Now, I thought when he said it is coming from another part of the business, he probably meant that you are transferring money from one division to a different division. So now when you transfer from one division to a different division, then I was going to ask him, is each division a separate entity? In that case, yes, it's contributed capital.
Yes.
If the company is the entity and the two divisions are part of the big company, then it's not contributed capital. All you're doing is transferring the money, but between one sub unit. Say for example, let us say that you have say two different divisions. Okay, so you have let's say the car division and the truck division of the same automotive manufacturer. You have the car and you have the truck. If you transfer money from the truck bank balance to the car bank balance, that's not a contributed capital, because your entity is the company. Take a hospital, for example. Let us say that the hospital has got two units. There is a medical unit and a surgical unit. And the medical unit has its own balance and the surgical unit has its own bank balance. Okay, you have a big payment coming up in the medical unit, and so temporarily you transfer the money from the surgical unit to the medical unit to pay the bill. That's not contributed capital, because it's part of the same hospital. The entity is the hospital. But if you define the entity as, if you say, okay, surgical unit is the entity, I'm drawing a separate balance sheet for surgical, I'm drawing a separate balance sheet for medical. Now, when you transfer money from surgical to medical, it becomes contributed capital to whoever is getting the money, because they are now a separate sub-entity as opposed to the one which is contributing the money. So first you have to define what your entity is. I thought he was going there, but that's okay. Yeah.
That would apply to a holding company. The holding company has
Yes.
a stock.
Now, the holding company is more complicated. By law, as a holding company, under US GAAP, the holding company's accounts is consolidated.
What's a holding company?
Holding company is something that owns other companies. So the big company is called the holding company. Correct? So when you have a say what would be an example of let us say a holding company? Amazon.com. Amazon.com, I believe, is now the holding company for the Washington Post. I think Amazon owns Washington Post. Either I could be wrong. I think it is the company that owns Washington Post. So Washington Post is a subsidiary of Amazon. Amazon is the parent, and it holds multiple companies. It may hold some other smaller companies not so well known. Okay? So that's the difference. But the point is that transaction becomes a contributed capital if it comes from an entity which is not what you're talking about. Anything outside of what you're talking about becomes a separate entity, and now that becomes contributed capital.
The 600,000 contributed from the owners. Do you have to show where it came from? What if it was an investment that was borrowed? Does that have to be?
No. When you say borrowed, then it cannot be contributed capital.
Okay.
Then now that becomes a loan.
Right.
Because then you say
Then it's a
borrowed, that means
liability.
you have to repay it.
Right.
So if you are the company and I may be a shareholder.
Right.
Maybe I am part owner of the company, but I write, you and I get into a contract whereby I give you the money under the explicit agreement that the money will be returned back to me.
Right.
Now it is not contributed capital; it becomes a borrowing by the company from its owner. So the owner is separate from the company. So the owner is actually now lending money to the company. But if the owner puts money into the company as part of the capital, now that becomes contributed capital.
And for tax purposes, that would just be different.
See, again, you're taking me into an area where I don't have the expertise. Now, see, the point is as far as tax goes, you would still have to call it as loan or borrowing from the owner. So it would not be considered as part. Obviously, it's definitely not part of profits either way. Whether you call it contributed capital or a loan, it is still not part of profits. But in one case, the liabilities go up. In the other case,
your stockholders' equity.
I guess my question is, what if it's a startup, right, and you get investors?
What is the what?
It's a startup company, and you
Yes.
get investors.
Right.
You owe these investors from that profit, right? So
No, wait. What did you say?
if you get people to invest in your company, right?
Correct.
to
And so
give you
what?
startup cash.
Okay, let me stop you right there. You get people to invest in your company. Perfect. What did you give them in return?
A promise.
Capital.
What promise?
Shareholder, shares.
Shares to be part owners to get some money back.
No.
No?
If you
Okay.
give them shares, no money is going back.
Okay.
It's not guaranteed.
Okay.
But if you borrowed the money, there is a legal guarantee that you will pay them back.
Right.
That's why I said, you got to be very clear as to what the purpose is of the money that is being received.
Got
If the money being received is against a note which says, I owe you this money, then
Then
it's
it's-
not
then it's a
contributed
loan.
capital, that is a loan.
Gotcha. Okay.
Even if it is from a shareholder, it doesn't matter. But that specific amount of money is a borrowing from a shareholder.
You can lend your business.
Right.
That's right. That's exactly right.
Huh?
That's exactly right. You can lend your business the money because now that goes into liabilities of the business, not the stockholders' equity. Yes, sir. Give me one second. Yeah, go ahead.
So profit that you make, that you throw back into the company, because of the future.
Yes, that's called earned capital. That's where the retained earnings comes from. The retained earnings captures all the profits that you have made.
And if you put that back, then it's called what again?
It's not, it is always considered back.
You're saying.
Now you will, when you start pulling it out as dividends, now it is, the retained earnings will go down. Because now you have removed some of the earned capital as dividends. Right? Yes.
And if you're starting a company, raise funds for it,
Yes.
would that be contributed capital?
That's why I said you have to be careful how you raise the funds. If you raise the funds against a promise of repayment, that's a loan. It's not contributed capital. If you raise the funds through issuing shares, that is making those people giving money as owners in the company, there is absolutely no implicit or explicit promise of the money ever going back to them. They have become owners.
What about donations?
What about what?
Donations.
Donations. Again, donations are considered as part of contributed capital because by definition, donations don't have to be returned.
What if you
So
just
it
don't
is part of contributed capital.
What if you just don't have a payment? Let's say your parents give you a loan.
It's your money.
Say that again?
Let's say you
No, the question is not what you do. The question is what was the intent when the money was received.
I'm just saying this is a good way.
You can't say. That's the point.
For me to still own it without having to pay them.
It is the intent. At that point, did you write up a piece of paper? Listen, at the point that you received the money, did you write up a piece of paper? Which says that, let's say you are the company. Let's say I am the one giving you the money. I could be family, friend, anything. When I gave you the money and you got the money from me, did you and I write up a piece of paper?
Yes, it would be a loan. And I just.
So you have a liability.
basically just never paid you back.
That's not the point. There is no question. No, what does the paper say? Does the paper say loan?
It's a loan.
If it's a loan, then it's not contributed capital.
It's a liability.
You're defaulting on it, that's it.
Let's go.
Yes.
No, that's,
About tax credits, you're not doing equity. But
It
it's
does-
still considered under accounting as a liability.
because the paper says, that's what accountants go by. The accountants go by what is the stated intent of that money being received. The stated intent is that it is going to be repaid in future. So it's a liability, period.
Doesn't understand Spanish.
I know. I'm playing.
No,
S corporations.
no, it doesn't matter. Even if you are the sole proprietor. Guys, everybody listen to this. This is very important because it is such a prevalent, method in the healthcare system. Because there are so many sole proprietorships that are incorporated as S or C corporations. So therefore, it is extremely important for you all to understand the difference between you being the owner of a firm and the company that you own. They are two separate entities. Extremely important. If you take money from a company's bank account and buy groceries for your house, how will the company account for it? As an expense? No. The company will account for it as withdrawal by the owner. It's not an expense.
You're not
Yes.
buying the.
Perfect, you got it. Dividends. It's not an expense. So the company's profits don't change.
Was
It's very
reduces the
important to
capital.
understand that. So again, if let us say that the company wants to buy some office equipment, and there is no money in the company's bank account. So what do? You buy the office equipment through your personal cash. You are the owner of the company, you can do whatever you want. But you buy the office equipment through your personal cash. Now what you have done, you have donated office equipment to the company.
Or the company
It's
loans
part
you
of-
money.
It's part of your, or the company, if it is, then it could be a borrowing, you're absolutely right. The company, you will take it back from the company, then it's a borrowing. The company has borrowed money from you. Always, never ever confuse the entity relationship or the entity, difference between the owner of a business and the business itself. They are two separate entities.
Yes, yes.
And it has nothing to do with taxes. This has to do with accounting. Accounting recognizes that the owner of a business is an entity separate from the business itself. Yeah, sorry, I'll be with you.
This is strong correlation, okay. I respect what you're saying about that. There's a strong correlation between accounting and practice. Like, the last example you just gave, the owner would donate funds to have large expenses for a year according to tax. How can accounting and taxes not be married to each other?
Well, first of all, it is, okay, I'll give you a quick answer for this. And it will be a convincing answer, believe me. The reason, it's not really accounting and taxes are different. You're not stating the question correctly. What you're essentially saying is, accounting for stockholders, for the purposes of stockholders, and accounting for the purposes of the IRS, how come they are not the same?
In proprietary.
In an ownership company? Because the reason is, when you look at accounting for the purposes of stockholders, that's all I'm talking about in my class. That is based on an economic relationship. It has nothing to do with cash. There are lots of things that you will do in that purpose, from that purpose point of view, that will have no relevance from a tax point of view. If I am the IRS, I don't care what you're doing for the stockholders. I want to know, are you meeting the IRS rules? IRS rules. I'll give you a classic example of how the IRS rules can actually, change. Take for example, let's say you invest in an equipment which is energy efficient. And the government suddenly says, oh, okay, you know what, we want to promote energy efficiency. So we want to encourage everybody to invest in energy efficient equipment. So your business invests in an energy efficient equipment. From the stockholders' point of view, that equipment has a long life. So the depreciation of that equipment will be spread out over a long period of time. But tax is controlled by government. And government is controlled by politics and fiscal policy. So government says, oh, you know what, we want to encourage everybody to invest in this equipment, so we allow you to depreciate this equipment in total in the very first year. So you have to depreciate the equipment in total, if you want to. You depreciate the equipment in total in the very first year, so pay very little taxes. But for that purpose, no, you can't do that. They'll still demand that you set a useful life for your equipment and depreciate it over that useful life. So your profits that you report to stockholders and the profit that you report to the IRS will be different. And that is for good legal reason. There is no hanky-panky there. You are following the rules of the IRS and you are following the rules of GAAP. And they don't have to be the same. And the problem is that the rules for the GAAP are driven by economics, whereas the rules for IRS are driven by politics. That is the reason why you have a whole lot of tax specialists who are not accountants but who are actually lawyers. They are not accountants. A lot of the tax specialists are lawyers because they understand the law that Congress passes in order to promote certain types of economic behavior. So tax people, the tax specialists need not be always CPAs. A lot of them are actually lawyers. Yes?
So, just to see if I understand this, I understand that if I'm an owner, I can like, negotiate terms and, basically borrow